But being consistent as a day trader does not mean you are going to make money every day or every month or even every year. Being consistent means you show up, you follow your rules, even when you're in the down periods.
So I know it's not the popular answer. It doesn't sell courses. It's not exciting. It's not flashy. But going for slow and steady returns is the only way that I know I can do this long term. I can compound money over time. And taking the tortoise approach and the turtle and the hare story that we all grew up learning, is really ultimately the only way I know to win the race.
I used to take a lot more trades than I do now because I'm really looking at things going, is this really worth taking? And the answer is yes or no. And if it goes higher, I don't care. Can't miss the trades that I should have never have taken in the first place.
Definitely. A lot of challenges at first, because I think one of the biggest ones, and I'm sure I've been listening to your interviews now, like I told you, since 2017, 2018, and you come across this with a bunch of people. Self-sabotage ruins traders. We get in our own way all the time. So I didn't realize that at first. So while my technical analysis may have been good enough, my psychology was not nearly where it needed to be in order to be able to be consistent. And I think part of being consistent in trading, when you first say that to a new trader, that tells them in their brain that they're going to make money every day. But being consistent as a day trader does not mean you are going to make money every day or every month or even every year. Being consistent means you show up, you follow your rules, even when you're in the down periods. And that took me a long time to understand, because every time I'd get into a period of drawdown or take consecutive losses, I'd be pissed at myself and I would end up just taking it out on the market. So that self-sabotage set up tons of hurdles for me in the beginning that I feel like hopefully now through people like yourself and me, a lot of these new guys, they don't have to go through as long of a period of pain as I went through. But I think other than the psychology side, the technical side, I felt like I had a good grasp on, because a lot, if not 90% of the courses that I watched were all technical analysis. Very few people were educating on the psychology. So that was something I just had to learn for myself. But I think if you go deeper than YouTube videos and you go deeper than courses, you can find that psychology, because there's, as you know, many great traders. Self-awareness. So part of my journey, I would say my trading in the last 4 years was much better, of course, than it was in the first 3 years. But a big part of that is probably because I've done a lot of mindfulness work, which the mindfulness work outside of trading, I think, has transformed into beneficial characteristics that show in my trading, increasing my patience, increasing my discipline. And I think when like mindfulness stuff to me, meditation every day, I've been doing yoga for longer than trading, but I actually got my yoga teacher certification last year. So doing things like that, that really push me to be a student, be an amateur, learn something new, mindfulness, breath work, all of these things I am an amateur in, but they have made a direct impact in helping me see myself, I think, better. And then by understanding my own strengths and my own weaknesses, that's where you can then say, yeah, my strength may be in my technical analysis, but I know that I'm not thinking how I want to be thinking when I'm trading. Something's going on. I'm emotional. I'm flip-flopping. Without awareness, you don't even realize that you're buying Bitcoin and selling Bitcoin on the same day, because you're just lost in the technicals. You know what I'm saying?
Totally. Yeah. Totally makes sense.
Yeah. So I think that was where I was like, okay, I'm not so much lost in the technicals because I'm bad at technical analysis. I'm lost in the technicals because my head is all over the place. Why am I buying and selling the same thing every day? Why am I chasing the momentum on things that I don't even trade? And all of a sudden I'm trading GBP CHF and I don't even look at that. Those things I started to like, it's almost like a flashlight was showing me my weaknesses as I pushed myself down that mindfulness path more through yoga, through meditation and things like that, which to some people listening, they're going to be like, that's so corny, bro. I ain't doing that stuff, but for me, it made a big difference. So I only can share what helped me. Nothing else came into my life at that point that would have been like the mental thing. It's not like I had brain surgery and got a brand new, nothing happened other than pushing myself outside of my trading to be my best self. Because I'm sure you'll agree with me on this. Your trading self is a direct reflection of your everyday self. So if you're out in the world and the characteristics that you exhibit do not align with successful trading, there's no way you're going to be able to come in and trade well. But if you can align yourself off the charts with the good behavior that you need to be good on the charts, I think that's where you find the sweet spot. What held me back for a long time in the results in the P&L was that I would building my first strategy was called the A1. And we're looking for the A1 entry. And I might see two of them present that day and I take them. And let's just say on this day, they were both winners. Then there's other trade ideas that I have. And because I'm egotistical, because I'm whatever I am, I think I'm always right. I'm still taking those trade ideas, even though they're off my system, off this strategy I'm building, right? Then at the end of the day, because I'm not tracking all of those trades properly, I can just say, hey, I had 2 wins today. And then that other thing I did, I won't do that again. Don't worry about it. And then it never gets talked about again. The mistake, the chasing the trade, the extra stuff never gets, and then it's like re-ingraining these bad habits into you by not taking accountability for your actions. So if you're in that point of like, I'm trying to figure out where my issue is, just start tracking everything. And I mean on the charts and off the charts. So like part of my report card that I do every day is it has a 15 section checklist for trading errors if I was to make any of those trading errors each day. I traded too small, I traded too large, I got in too late, I got in too early, I traded into news, all of those things. If you didn't do any of that, that's great. That's a good day. Then you should also be tracking your on the charts habits, the things that you need to do when you're at the desk to be your best self again. I have to do 5 playbooks. I have to generate 5 new trade ideas. I have to X, Y, and Z, whatever. I want to watch an hour of educational videos for trading, whatever it is, or podcasts. Those on the charts habits that some days we just slack off on. But if you have a checklist and a little accountability with maybe your community and stuff like that, then it's a lot more annoying at the end of the week when you look back on it and you say, oh, I'm not meditating as much as I thought. So along with the on the chart stuff, tracking the off the charts, working out, spending time with family, doing the mindfulness practice, all of that stuff should be tracked too. Diet, sleep, because like, again, as this is something that has become very clear. This is not an amateur's game. If you treat trading like a hobby, you get poor results. But if you treat it like you're LeBron James playing in the NBA finals, you will get better results. So I think I look at myself like a high performance athlete. I need to get enough sleep. I need to be eating right because this is the machine, bro. And if you put bad gasoline into the machine, the output is going to suck. It's not going to go the way it's supposed to go. So that's why tracking the stuff even off the charts makes a big difference too, because then you can see what areas of your life do you actually maybe need to make some improvements in that could then, without even doing anything else, just maybe start eating better and stop eating late at night, drink more water, simple things like that. All of a sudden, you start thinking a little bit more clearly. Here's another direct example I can give. I haven't had coffee in like 2 weeks, bro. I normally was coffee first thing in the morning, but I've cut it out now just with salt in my water and electrolytes. And I'm still going to the bathroom fine. Everything still works fine. I'm not having any crash from caffeine, but I'm noticing that I don't feel as jittery, of course, and as like anxious at the desk where I'm consuming coffee first thing in the morning and then I come to trade. I'm like wired, bro. You're like ready to go. But with the water, I'm noticing just the clarity of thought, the less erratic thought patterns and emotional patterns. So then you can get real into it when you're tracking everything and start to tweak it. Like, let's take coffee out of the equation. Let's try to do fasting and see what we get from there. Let's try to up the amount of playbooks that we do. If I do 10 playbooks a day of new trade ideas, could I end up coming up with a new strategy or a tweak to my strategy sooner? Of course. So I think it's tracking your trading errors, your off the charts and your on the charts habits, and then see where you're actually weak. But a lot of people, they'll build the spreadsheet, they'll do all that. And as you probably would agree, you'll know they will lie to themselves. You're not even lying to me. You're lying to yourself. If I didn't meditate today, but you still check the box. No, you've got to be honest with yourself, which I think for a lot of people, that's what mindfulness is. Mindfulness is being honest with yourself. So it's like, how do you get to that point to be willing to understand that you need that? Bro, some guys are like, man, I don't need that. I don't need that. No, we all need that. That's part of being a human being, but you just don't want to accept it yet. And it's holding you back. That's how I really feel. Day to day, I'm up around 6 o'clock, maybe a little bit earlier, New York time. I'll wake up, come onto Discord, see what's going on. Like this morning, Bitcoin's down almost 8%. So like on a day like today, I'm probably done trading. It's a Friday. I'm up this week for my 2 trades on Monday and Tuesday. So I'm not going to come in and be over aggressive, but I still will wake up. I'll work through my 5 main things, which is Bitcoin, US 500, US 30, NASDAQ, US 100, and US oil. Those are the things that I'm trading the best right now based on my last 2 months of performance. So I'll look at those and I'll see if there's some type of clear trend. One of the indicators that I use moving averages like most people, but I have it's called a Trader's Dynamic Index. It's a TDI. It has an RSI on the bottom, but the RSI also has a moving average applied to it, which has been back tested for us and shown that it's a really good indicator of market sentiment. It's actually an indicator that was created by Dean Malone. He has a company, he's an older guy. That one indicator has helped me really understand trend more than anything else. So if I can find good market sentiment, I'm going to stay at the desk that morning and I'm going to like get locked in to try to find a trade between 6 a.m. and 9 a.m. From 9 to 9:30, right before New York market open, I'm normally flat, if not stop loss is locked, because that's that extra volatility that we'll see at the open that sometimes I'll just tag you out like it did earlier this week. It tagged me out on the open on Bitcoin, and then it dropped from 9:30 into 11:30. So sometimes you just have your stop locked, you get tagged, and you keep moving. And then I'll go work out. I normally work out around 12 o'clock. So I'm off the desk from like 10 to 1 ish, have maybe some breakfast, hang out with my wife, and then gym. After gym, normally I'm back at the desk by 2 o'clock for calls, whether it's coaching calls, something for our business, or just looking at trading. I'm back at the desk from like 2 to 4, 2 to 5, and then I'm done. 5 o'clock, I'm checking out. Might go play FIFA, might go to the pool because I live in Florida, so it's nice all year. So something like that. 4 or 5 o'clock, I try to be done. And then there's some days where I'm sure you, as you do as well, you enjoy the privilege of being a trader where it's like, I don't want to do anything on that Thursday. I'm blocking off the whole day and I'm going on the boat. Or for you, I'm going to be traveling that day. So I'm not going to be doing anything. So I have those days as well. But like the typical flow is come in, look at those 5 major markets, see if there's trend, try to trade pre-market. If not, wait till after market open. And then I come in after New York session opens 9:30, 10 o'clock, and I look for trades. I have the guys that I work with, they trade the London session. I used to wake up at 3, 4 in the morning to try to do that, bro, but I'm getting old now. I know you can't tell under all this dark hair. There's some grays in here, bro. There's some grays in here. So I have to adjust as my lifestyle adjusts. I have a lot of friends here. I have a lot of stuff going on here. So to be able to trade the New York session is much better for me now than it used to be. And I miss out on a lot of big moves, bro. The swing traders that are holding trades for multiple days that can keep money in the market, they catch way bigger moves than me. I'm like Derek Jeter. I'm hitting singles. I'm getting on base more times than not. I'm getting my 1R. I'm getting 2R, locking my stop, and I'm not giving back. My win rate over the last 2 months is almost 80%, but my risk reward is just under 1. So I'm getting that consistent win. I'm getting to that 1R. Of course, I'd still like my average winner and average loser to be a little bit more separate. They're a little too close, but that's always something I've been working on. So for me, it's like, get in, get my money, get out. Get in, get my money, get out. And that's because I have confidence that this takes experience, but you know this too. The markets are not going anywhere. I could wake up in a month from now and just keep trying. I could take a month off. They're not going to care. I could take a year off. They're not going to care.
Yeah, and there are plenty of people, if you could imagine if your business were selling trading psychology advice, of course you would market it as it's the most important thing. I think at different points in people's journey, and I really have always thought of the process of becoming a trader, it's not something you learn. Like, you really have to become a trader. You have to change yourself and become a trader. And I think for every trader, there's a point where psychology is really important. And it may not be those points, may not be expected points in the journey, but you'll definitely run into it. But yeah, it's, one of the things that I think about trading psychology, so many of the people that I've worked with and coached and mentored, my point has been, you should have psychological problems with your trading. If you have a poorly conceived approach, if you have not done the work and have not done the back testing, you should not feel good about that. I worked with a trader who refused to do any quantification of his system because he believed very strongly in his intuition, which is fine. I suppose that could be a legitimate approach, but his numbers for several years were strongly negative. So, what I had to do as a coach was to really kind of grab him and say, hey, do you see this? Do you see that this number is less than this number? And that's your equity curve. And it's quite consistent. But my message to him was, he was like, well, maybe, he just wanted to work on psychology. And I said, you should feel bad about what you're doing. you're getting a clear message from the market that you're losing, and you should not feel good about that. So yeah, I think my approach to the psychology is going to be a little bit different than what you probably heard in the past. Discipline is one of those things that everybody likes to talk about it, and it sounds, we like to be very macho when we talk about trading, and discipline sounds really strong, and it sounds like, oh, of course you just have to have ironclad discipline. And I think you're absolutely right. The reality is that if you have trouble with discipline, it is many, many times a symptom of something else. And the other thing that, on the discipline topic, one of my mentors said this to me. You know how I think at the end of your trading career, you'll look back and there will be a few things that stand out. And, maybe, I don't know what, like half a dozen things that people have said to you. And this will be one of the things I always remember. He said to me, Adam, if you're not disciplined every instant you're in the market, you can't say you're disciplined. You can be a disciplined trader. You can do 40 trades in a row and do exactly the same thing. And then, I know where my Achilles heel is, and it's that I tend to take profits too early. And that goes way, way, way back to my initial formation as a trader, and it's something that I have defeated that. That's not a problem that I struggle with now, but I know that's probably what I'm vulnerable to. But so, I know I could do 40, 50 trades, and then on one trade, I get a little nervous or I'm having a bad day, and I take that profit early because I don't want to see the profit go away. I'm not a disciplined trader. You have to be disciplined every moment, every instant of your interaction with the market. And that's not, that's something to aspire to, but I think a beginning trader can't possibly hope to do that. And that's just a symptom of all of these other things that are, going on as all the pieces of their trading fit into place. And a lot of these things are very simple. The solutions are so simple that you would not believe they would work. One of the things that I found to be very effective with traders is you put a rubber band around your wrist, and when you are about to make a mistake, it's a pattern interrupt. When you're about to make a mistake, you snap the rubber band, so you hurt yourself a little bit. It's not like you're whipping yourself or anything, but the pain of that rubber band just before, like, if you, let's say for instance, that your weakness is you cancel stops. A lot of traders do that, right? It goes down to your stop, and then rather than getting stopped out, you're going to cancel the stop. And we know this is one of the very dangerous ways we can destroy accounts. So, what I would tell a trader is, okay, you can do that. But before you do that, snap the rubber band. And what you will find almost every time, the act of doing that just wakes you up enough to say, hey, I'm about to do something stupid. I'm not going to do that. I'm not going to push the button. So that kind of pattern interrupt can be a very powerful thing. Another thing that can be very effective, visualization is a powerful tool, but you have to use it correctly. And one of the best ways I know is to imagine a situation that causes you a lot of anxiety. So it could be, for instance, where that market is ticking down to your stop. We've all been there. I've been there several times today. And, how do you feel as it gets closer to your stop? So what you can do is, away from the market, you can sit in a quiet place. You can call it meditation if you want. You can do it. You can lie in your bed before you go to sleep, and you can imagine putting yourself in that situation. And then what I would encourage you to do is to create that physiological stress response. Make yourself breathe really fast. How do you breathe when you're scared? You breathe shallow, you breathe fast, and it affects the chemistry, the pH, and the balance of all the gases in your blood. And so make yourself do that. And what you can do is, away from the market, you can replicate the stress of coming down. What I'm using the stops just an example. Whatever stresses you out. For some traders, it might be taking an entry. It doesn't matter what it is. And then what you do is change your breathing to slow, deep, and relaxed breaths, and see yourself taking the right action there. a day of that, simply doing that exercise, takes maybe half an hour if you do it with intention. Do it a few times. It can have a profound effect on behavior. Another thing, what has worked for me over the years is different things work for different people. But for me, my self-talk is very brutal. I will always, I'll say things to myself like, you're really a fucking idiot, which is not, if you're going to do that, are you stupid enough to do the same? And you could, what I'm describing in the wrong context could be a very destructive thing. It could be a spiraling cycle. But for me, my reaction to hearing myself say that is I kind of get angry at myself and I say, no, I'm not that stupid. I'm not going to make that mistake. And so very aggressive. And, it's almost like I joke with myself, I guess, but very aggressive, very negative self talk breaks me out of things. And the way that it was a persistent problem, 20 years ago when I was trading the S&P, that I would take my profits early. And the way I got out of it was at the end of the day, I looked at every trade and I simply made myself feel really bad every time I did it. And I, eventually got the message, kept telling myself, if you keep doing that, you're not going to be a trader. So you just know you have to change your behavior if you're going to stay in the game. A lot of different things for different people, but those are some things that work for me. And I think, if we're honest about it, one of the other things is that, the turtles, people who have educated themselves in the lore of trading, they know the turtles, they know the experience of the turtles and those kinds of, breakout and then trailing stop systems. And they know those kinds of systems generate what they forget is they generate like win ratios of like 20%, but they will generate gigantic wins. So I think there's a little bit of that, and I think maybe there's also a little bit of like Warren Buffett syndrome, where people know that that's a guy that hits some colossal home runs, and like everybody wants that 10 bagger, but it's not the way. If you're an active trader, I don't think that's how you're going to get rich. One of the ways I think the market has changed, and this is research that's still ongoing, but I think 20 years ago it was fairly possible to. Well, I mean, let me not be so academic about it. I had sets of things that I would look for that told me that tomorrow was more likely to be an extended trend day. And they were things that everybody knows, like, compressed range. Toby Crabell's narrow range 7 was a good thing. Other things like, but all around that same concept of the market being very compressed. And my testing today shows that I don't think those edges are there anymore. I think that has come out of the market. So basically, in the past, it was possible for me at least, and maybe other people are able to do it. Maybe I'll figure it out, because as I said, I'm still kind of putting the pieces of this new thing together. But it was possible, like I could come in and I could say, okay, today's a day that we're likely to see a big extended trend. So I'm going to try to hold on to pieces of these trades for that extended trend. Or I could say, today is going to be a choppy day. I'm going to take really conservative profits and be done with it. I don't have the same confidence based on both my statistical work and my very intense trading since the last quarter of last year. I've been doing this. It's like each day is a little bit more of a completely unknown new adventure, and you don't know, like you don't know. So I think maybe without that degree of, it's essentially a higher time frame context and bias. If that's not present, then you probably are better off defaulting to the 1 hour trade. And what people do, or 1 hour, perhaps even smaller in some cases, what the people who love, if you're one of the people who you're listening to all of this and you're, I know somebody's listening to this and you're thinking, okay, like these guys kind of sound like they might have some idea what they're talking about, but I still like to catch the 4 hour trade. So I'm going to do it. And it does feel good. I would tell you what you're not appreciating is also how good it feels to take 3, 4, 5 1 hour winners in a row and to know that nothing can hurt me. And now I've just gotten in and out, and also the power of seeing that equity curve go up pretty. That's a pretty good reinforcement too. But there really is something. It's a harder sell. Catching those big wins feels good. It looks good on the chart, but there's also, I derive a tremendous amount of satisfaction from just taking these small trades. That feels really good too. Feeling that that's certainly one of the most common things, the FOMO, fear of missing out, and all of its different ways. And that's the big one, right? You took the little profit, and then the thing just collapses. And there's some part of your brain, no matter how good of a trader you are, how disciplined you are, there's some part of your brain that says, "Oh, I knew it." No, you didn't. No, you didn't. And had you, there's where you have to step in as a very dispassionate, very logical, and as much as possible non-emotional person, and say, you probably didn't know at that time, and anyway you would have ripped up a ton of money on 15 trades trying to catch that. But yeah, that's the thing that you're going to struggle with when you start taking these smaller profits. And also, in my experience, the universe has a bit of a sense of humor. So if you're listening to this podcast and then you're going to go try to do this, I would bet your first trade is going to be one of those examples where you take the nice little 1R and then the thing just explodes and you're going to kick yourself. But stick with it. Like any change you make, you need to collect a reasonable sample of events before you can really evaluate it. So you want to get several tens at least before you can.
I'm a really big proponent of just going slow. Like I'm not interested in big gains, fancy gains. I'm all about like slow and steady, because I'm sure you know this too. It's like, if you want to do this for the long term and you want to have like a sane existence, you've got to risk small, because if you're risking aggressively, if you're trading like a lunatic, it's only a matter of time before you're back to square one and you've blown accounts, and that's just not a sustainable approach. It's almost like I listened to you may remember, and you've probably interviewed him at some point or another, Rob Booker. Do you remember or know Rob Booker? Yeah, Rob Booker. So he had something that I listened to back in my college dorm that like completely changed my trading life, which was he was such a big proponent of small positions. And he's had this simple message for a long time. He's like, everybody is so, they complain so much when I say go slow and steady and make 1% to 2% per month or whatever. But he always asks the audience, but how much are you making right now? And if the answer is, for most people who are, inevitably, sadly, losing traders, the answer is they're losing, multiple percent per month, if not more. And so he was pointing out the idea as basically, instead of be angry that I'm mentioning 1% to 2%, is making 1% to 2% better than losing 5% to 10% every month? And the answer is obviously yes, but most people don't want to accept that. So I know it's not the popular answer. It doesn't sell courses. It's not exciting. It's not flashy, but going for slow and steady returns is the only way that I know I can do this long term. I can compound money over time. And taking the tortoise approach and the turtle and the hare story that we all grew up learning, is really ultimately the only way I know to win the race. So when I got into trading, and I was also nervous to lose that money that I'd worked so hard to make from my other, ventures, I actually really embraced. I think I loaded up like a $500 account or something like that with a broker, and started trading like 0.01 lots, and had some wins, had some losses. And I realized very quickly, like, okay, this is way harder than I thought it was. And I don't want to like take another live trade until I do some testing. And that led me down just a campaign of back testing. And I think that the truth is, most traders approach the markets with an interest in making money, which is totally understandable. Everybody wants to make more money, and everybody hears about trading through somebody who's made a bunch of money trading. Like, that's an understandable, and it would be kind of gaslighting for me to say, like, that's a crazy thing to come to trading because you want to make money. But I also, kind of was just enamored by the markets. I was interested in them. Like, and I think that is very important for becoming profitable. So for me, once I realized, like, oh, this is actually kind of hard, I just explored markets, like, without even trading, just like watching people's videos, listening to things, and I started back testing a lot. And I started very quickly finding I could program stuff in MetaTrader, which I know you're familiar with, like creating bots and creating systems. And I'm sure this will resonate with you too. Then what I found very quickly with that is I picked up how to program that, because again, that's what I went to school for. So I'm learning how to program in here, and I'm running through data, back testing stuff. And I realized really quickly, wait a second, this is really hard. Like, it's really hard to find an easy edge, and all these videos on how to, make all this money in the markets, they're not real. They're like, I'm testing these systems and they are far, harder than what meets the eye. So I think with my software approach, programming, trading robots and things like that, I realized very quickly that trading is difficult, that building or finding an edge in the market is difficult. And what I kept finding, and this was at the same time I was listening to Rob Booker every day. He was playing around with expert advisors as well and building stuff. And what I kept hearing him say was, just accept making $1 and keeping it and trying to make a small amount of money and just doing that consistently. I heard that over and over, and then I started seeing it in my back testing. I was like, wait, I keep seeing this thing blow up in the back test if I try and go too fast. But if I go slow, if I trade with small size and conservatively, some of these systems are actually working. They're making more than they're losing, and they're generating capital over time. But the variable there that's kind of frustrating is the time part, right? If you can manage risk and go slow, you can make good money over the longer term. And so that was where it kind of clicked for me. I realized through backtesting and through listening to, Rob's like monologues, that small risk is kind of the secret to surviving the drawdown, right? That was the big secret, if you will, is like, you have to be able to survive drawdown. That's the only way to trading profitability. So that was my big breakthrough, was stop focusing on, reward and start just focusing on risk, and the rest takes care of itself. I didn't want to believe it, if that makes sense, with the whole, I've got to risk small, because it's so not fun. I remember being so bummed out because I was like, even with the capital that I had built up, I was like, I'm still not going to be able to do this for a living. Like, if I'm going for 1 to 2%, I think at the time I may have had I don't know, maybe $40,000 or $50,000 saved up from all my stuff that I had done. I was like, this is still not going to, in Atlanta, Georgia, rent is expensive, right? So I'm sitting there, I'm like, this is not going to really pay the bills handsomely. I'm not gonna look like those super wealthy influencers I'm seeing in the trading space anytime soon with this kind of return. So I think at first, in terms of a mindset shift, it was gradual. I actually remember when I sort of came to the realization that, okay, the only way to do this is go slow and make slow and steady money. I remember stepping away from trading for a few weeks and just being like, okay, I've uncovered the truth about this stuff, and it's not very exciting. So I don't know if this is right for me. But then I continued to find myself like watching videos and learning about the markets and like exploring things. So I realized maybe this doesn't need to be my primary, immediate, like savior income source, but I do really like the markets. And so I realized like the only way forward was to accept that this is a long-term game, and only push forward if you actually genuinely love learning about the markets. If you don't, I say it all the time, I don't think you can become a profitable trader and stay consistent if you don't actually have a love for learning about markets. I really think that is a need, not a, this is not a side hustle. This is your primary focus if you want to get good at it.
There wasn't any electronic trading at that time, and I had a really good stockbroker, and he taught me things and showed me things and helped me figure out what to invest in. And we did really well. And I was not only investing in stocks, I was doing municipal bonds and land deals and gold and diamonds and, all kinds of things. as far as I'm concerned, if it moves, you can trade it. He even said to me, why don't you try trading futures? And I thought, no, the people who lost $75,000 for me were trading futures, and I'll never trade futures. Famous last words, right? I mean, now I trade futures every day. I was plotting these charts and I showed them to my broker and said, we're going to have a crash. This was in September of 87. And I said, sell everything that I own. I want out of this. I think it's going to go down sharply. And so he said, no, this is the biggest bull run in history. You don't know anything about these charts mean nothing. You don't know anything really about the stock market. And I said, well, it's my money, so let's sell it all. So we sold out, cleared everything out of the market, and the market crashed in October. And then so it crashed 105 points on Friday. It crashed 506 points on Monday. On Tuesday, I called him and said, buy everything you can get your hands on. So that was it. I was hooked. That was trading. And I started trading the S&P in 82, I think. But I started trading the S&P and I was trading it on daily charts at the time because we didn't have access to real-time data yet. Well, it wasn't easier. I mean, it's always been a challenge, but it was much slower back then. You could trade daily charts and do really well. And it was just slower moving, and now it just moves so quickly. And today was, for instance, this morning it started out just chopping back and forth, and it didn't do that back then. And we didn't have real-time data. We had to look at end-of-day data for everything. There really wasn't any software yet. The first software was by Tim Slater. It was called CompuTrack. And I used that in the beginning, and then I switched over to System Writer, which was made by the people who are now TradeStation. So I started using System Writer as soon as it became available in 1986. And I bought tick data from a little company called Tick Data Inc. And I would massage it into 15-minute increments and create my own charts that look like 15-minute charts, but the computer thought they were daily charts. So you had to play around with things back then. You had to be creative. It was just a natural progression. Yeah, I mean, I knew I wanted to see more inside the market than daily data allowed me. And so like I said, I created these 15-minute charts, and from there I went to 5-minute charts. And actually I traded 15-minute charts for quite a while. And then it just got faster and faster. And now I trade 5-minute and 1-minute charts. It's the same patterns, just on a different time frame. I mean, we still have up markets, down markets, and sideways markets, and that's the whole game. So the trends now are on shorter term charts. I mean, on the daily chart, you can go sideways forever, but on a 5-minute chart of the very same thing, you can pull out lots of trades. I've been trading for 42 years, but I'm still learning every day. I print out my charts every night. I've got notebooks full of charts. I print them out every night and I analyze them and study them and get ready for the next morning. And I study my charts while I'm trading. I think chart time is really important. When you do pen to paper, you learn more from it. And remember, I started out plotting charts on a piece of graph paper. So I find that when you do it by hand, you learn a lot more from it. You learn a lot more from the moves. I also have another indicator that I call PHW. It stands for potential hourly wage, and it plots yellow dots at all the ideal turning points. So I'm looking at the yellow dots with respect to my own indicator, Sunny Bands, and I'm saying, what did Sunny Bands do with respect to these yellow dots? And I look at that every single night. Is there anything else I can learn from my own indicator and the way it behaves with the market? Calculating things by hand, or at least in a spreadsheet, is also important. I mean, if you go back to, what was it, 1972, when Wells Wilder wrote his opus work, all the calculations in there are done on columnar paper, so that he calculates everything by hand. And I've done all of his calculations by hand, and I think that's really important. And I think there's something you can learn from muscle memory that you can't from just sitting there and trading. Well, when I was first trading the S&P, it was the big boy back then. It wasn't the E-mini that we have now. And I had traders on the floor, and I would call them up on the phone and tell them, hi, this is Sonny Harris, account number so and so, buy 20 S&Ps at the market, front month at the market. And after 3 days of that, they said, you don't have to say all that anymore. And I said, why? And they said, because you're the only woman that calls the floor. So there weren't very many others. I was one of the very few, but it made sense to me to do it. And it was just appealing. It was something I really, really liked. I've always worked harder. I'm a workaholic. So, I still work 12, 14 hours a day, weekends included. I like to work. I like to learn. I like to read. I like to challenge myself in every way I can think of. I used to be afraid of the ocean, so I learned to scuba dive. It's that kind of thing that I do. Whatever I'm not good at, I work at. Gosh, it's hard. You have to put aside when you're making money. You have to put a lot of it aside so that you'll have a buffer when you're not making money. Because sometimes the market pays you, and sometimes you pay it.
If you have a bad month, bad 2 months as your personal trader, you don't have to tell anybody. You can just be like, I had a bad month. And maybe you're not forced to kind of really look at it and figure out why. But if you know each month, or even on a daily basis, my investors have access to their account 24/7, meaning they can see what's happening. So you're always questioning, not in a bad way. You're just kind of going through that checklist and making absolutely sure that you are placing a trade that meets all the parameters. So you're right, to bring it up in that light, that was a big step. I was already, in the public eye, given how long I've been in the industry and interviews I've done. People know about me, and people that are on my newsletter, they see the performance. But again, that's very different. They're still one step removed. They may not be invested in my fund, but they're getting the performance. So I'm still on the public stage that way. But when you start managing money and have to produce the track record, that takes it to a whole other level. And it forces you to really step up your game. Like you said, push outside your comfort zone. Risk management for me, when you're on that time frame of a trade, you have an absolute dollar amount you don't want to lose, obviously, and your stop is set accordingly. But for the most part, when I get into a trade, I'm expecting that trade to basically react almost immediately, because I'm hopefully timing the market that I've hit an inflection point. So oftentimes I don't even need to wait if I'm wrong on the trade. I don't even need to wait for my physical stop, even though there's not a physical stop set most of the time. I don't usually need to let it get stopped out, because either the trade's going to start working or it's not. Market conditions start to shift, and you don't have to wait for your stop loss to be hit to say, you know what, this is already deteriorating. Why risk even more than I have to? I'll just close it early. So I don't give positions that much room, although I never really have. That's just not been my style. I'm usually trying to get in at those inflection points. So, I would say pretty much risk management's always been a pretty important, very important thing for me. It's really no different different now. It just might be maybe a little bit more dialed in. I think in at least foreseeable future, the only thing I would have to change at some point is when AUM becomes a point where the size that I'm moving in and out of the S&P market might be a bit prohibitive on a trade that might be that short term in nature. So I might have to make some adjustments there. I might just have to get better at order management. But that's still a ways away. I've estimated, a certain AUM that I'm not there yet, probably won't be there for another couple of years. And when I get there, I'll start to cross that bridge. I am working currently, and I'm still trying to still trying to develop some slightly longer term trades in the S&Ps and 10-year notes. And when I say longer term, trades that might last a few hours, maybe a day or two, nothing crazy. And now, if I get to the point where I'm comfortable with those types of trades, then the size of the order being placed becomes a lot less critical. I don't think I like literally thought about how do I tighten up the process. I thought about how do I start to see the market better, and as a result, tightens up the process. And I think the awareness I had, and we touched upon this when I was on with you a year or so ago, and we even touched upon it in the interview in your book, is I moved away from more of a subjective analysis approach, and which is what most traders do, and some traders do it very well. Um, Probably not the best approach for me. I moved to something very much more objective, where I'm trying to read what the market's doing, as opposed to coming in with a forecast about what I think the market should do. So I think the further I've gone down that exploration of trying to get in sync with what the market's doing, where are orders likely to be that are going to hold support or hold resistance, that right there has tightened up my process, because now I'm in sync with the market, as opposed to saying, I think we're going to go higher from here. Those words just don't come out of my mouth anymore, because I don't think the market's going to go higher. I just look at that and say, this appears to be an area where the market has support. I will get long here based on certain conditions, expecting that it will go higher. And if it does, great. And if it doesn't, then you bail on the trade, or your stop loss gets hit. So I think by just approaching the market from a very objective standpoint, that in and of itself tightened up my process. Just having conversations with colleagues of mine that have been in the industry just as long as I have, we've all had our ups and downs. And I think we're at that point in our career where we realize that um, there's no reason to take anything but an A+ setup. It's just not worth the capital. And if it works out, and let's say it's a B setup and it works out, I'm not saying that's a bad trade, but I'm also saying that on some level, you might be reinforcing a habit where the next time that B setup shows up, and that'll be the one that'll ding you. Because maybe 6 times out of 10, that trade will ding you because it's just not a great setup. But if you catch it on the one time where it does work, you're probably getting rewarded and getting a false sense of, well, hey, maybe that is a proper setup, when in fact, based on your experience, those aren't good setups. So there's just no reason to take those. I would take a lot more trades than I do now, or I used to take a lot more trades than I do now, because I'm really looking at things going, is this really worth taking? And the answer is yes or no. And if it goes higher, I don't care, or at least I try not to. I'm a human. I'll sometimes get frustrated and go, geez, why didn't I buy it? But then I have to remind myself, can't take the trades that I should never have taken in the first place, or I can't miss the trades that I should have never have taken in the first place. I think it's probably a function of experience, really narrowing down what constitutes a great trade setup. I think there's that bridge between, okay, here's the setup. Let's just say it's 4 check boxes. Price level, volume, volatility index, and let's say option flows. Okay, check. Great. The next step is you take that leap where your experience kicks in. On paper, it looks great. You're waiting, and then suddenly you're like, no, this just isn't going to work, or I don't think it's going to work. And that just comes from experience, and that really can't be taught. It's a learned thing like any other craft. That's why some attorneys are really good, some surgeons are really good. Doesn't matter what you do. You've seen it enough. You're like, this is the one. And that, again, that constitutes the A+ setup. So you bring up a good question, because it actually allows me to kind of focus in on something that I hadn't yet. Even if you have all your check boxes checked, that doesn't necessarily mean you're jumping in. That just gives you the go ahead. Like I tell clients all the time, I'm doing scenario analysis 6, 7, 8, 9, 10 times a day. If this comes together, I'll do this. And oftentimes nothing happens. It doesn't all come together the way you want it to. So just because you have the boxes checked doesn't mean you immediately press the button to get long or short. Then it's a question of, how's the market reacting to what you thought, not what you thought, but what you identified as a good support or a good resistance level. Is the market respecting that? Is it? Okay, great. Is the market starting to accelerate away from that level? Okay, great. Then you really start to kind of get a sense of whether or not you should press the button. I think for me at least, maybe other traders do it differently. I never just buy into a support level that I've identified. I want to see what the market does with that level. How does it react? Do things start to improve once it hits that level? That's the level of experience that I think you just can't really teach because it's slightly different every time. There's no canned answer for that. Um, it's just one of those things. So for those of you that are listening, if you put in the time, eventually these things just start to become normal, normal occurrences. You'll start to see and literally you'll just start to kind of see and feel the market, about what it's about to do. Ideally, what I want to do is I want to get into the trade, and I always have my first price level above or below, depending if I'm long or short. Ideally, I want to get to that first price level if market conditions remain in sync with the trade. I'll take off 75% of the trade there. I'll take off another 15% at the next level, and then let that remaining 10% run. Those aren't very often because the markets don't trend like that because they're always back and forth. However, there's a caveat to that. I'm not going to just sit there and go, well, I'm going to wait till either I get stopped out or I get to that first price target before I liquidate. That's not how, in my mind, how you have to play the game. If you get into the trade and starts to move towards that first price target, but then the market conditions start to shift and they're no longer at your back, or they're no longer conducive to you being long or being short, you have to forego the whole notion of, well, I want that first target. It's like, well, you're probably not going to get it. And even if you do, there's no way to know that 5 or 10 minutes later that it was going to go there. You can only live in that moment. And at that moment, the market's telling you, market's lost its juice to the upside. This is starting to deteriorate. That's starting to deteriorate. Doesn't take a rocket scientist to figure out that the S&Ps are going to probably start to deteriorate too. So why don't you just get out, take your profit, and move on? A lot of traders get hung up on that. They hang in there. I got to get to that first target. I'm like, well, dude, the market's changed. It's not going to get to that first target, or it's unlikely to get to that first target. In my mind, if you're in a position and the market conditions no longer favor that position, that's a rule in and of itself. Now, what you might be asking, and it goes back to what we were talking about earlier, that gets into a little bit more of the finer points of trading. Or maybe it's just the ability to look at it and go, you know what? I thought this was going to be a really, really good trade, but it turns out it's not going to be that. All you really have to do in those situations is simply pay attention. What got you into the trade? The same checklist that brought you into the trade. Let's just make up a scenario that would be fairly realistic. Support level hold. Do you decide to get long? Volatility index, the VIX starts to move lower. That's going to drive the S&Ps higher. Okay, that's a checklist. Option flows in your favor. Okay, great. That's in my favor. Aggressive buying. The buyers are lifting the offers. There's not limit offers. People are lifting offers at the market. Those are all reasons to get long. Now let's say the VIX starts to rally. Option flows start to go the other way. Suddenly there's an aggressive seller. Those are all the things that never would have brought you into the trade. So why should they keep you in the trade? So that to me is a rule. It's basically thinking quick on your feet. Have conditions changed? And you and I could probably come up with a great sports analogy. If the quarterback's looking to throw to the wide receiver way down in the end zone, but he's covered, he's not going to say, well, I'm just going to throw it down there. That was the play call. He's going to be like, well, who else is open? Oh, and nobody's open? Okay, I'm just going to throw it out of bounds, or I'm going to hand it off to the running back. And maybe he only runs 5 yards, but that's the only play we got right now. Things change and you have to adapt in the moment. It's that space in between where you ultimately get out or where you ultimately want to get out, which is your ideal target, and where you get in. It's that middle ground that people need to work on. You've got to be honest with yourself and go, yeah, this isn't working anymore. Or maybe it's just stalling. Everything still looks good. You hang in there. You just hang in there because nothing's changed. Or even if prices start to squiggle down a little bit, if you look at your inputs and you're like, well, nothing's changed, you try to hang in there. It might be uncomfortable, but managing that position is the hard part. Getting in and going, okay, I'm holding it for another 10 points. That's easy to say, but Markets don't always do that. Once you get into the trade, now it's all new information coming at you, and you have to sort out whether or not that information is for you or against you in terms of your position.
That's what hooked me up. That's where I got a step-by-step process on what exactly needs to be done. And it was a difficult process overall. It took me 3.5 years to be even consistently profitable. It was a long time. It was a very frustrating time because when you're passionate about something, when you want to do something, and I come from a very technical software engineering background, and I thought I was smart enough to be able to start making money in the first month or 6 months. But it took me very, very long time. I would say 3.5 years. Very difficult every single day. I wasn't blowing up my accounts, but I was taking those small hits which end of the day added up, and ended up, after commissions and everything, I was losing money. So yeah, that's where it started. But eventually, the I wouldn't say there was an aha moment for me, where it's a process of being in this career and you start learning from all the mistakes that you're going through. But one thing that absolutely I would credit to on my career, or which was a game changing edge that I call it, which is called as a tape. And I got exposed to tape close to after 2 years or 3 years into trading, and that's where I started reading things that were going in front of me, and I started enhancing that skill set, which actually I would give as a credit to the tape reading perspective that made me consistently profitable. And I wouldn't like, one of the things that I avoid saying consistent, because you're one trade away from so you have to be very cautious when you say consistent. I'm consistent so far, but you always want to be on the a very cautious mindset that the next day could lead to a completely different mindset altogether. So yes, it took me 3.5 years to lead consistency, and price action and tape reading was one of those areas that I would gave me that consistent edge. There are multiple ways to be consistent. Well, there are multiple. First of all, you identify your edge, and that's a lot of traders. They have a process based, or a growth minded process, where they're creating their playbook, they're creating their setup, they're creating their patterns, but it still might not lead to consistency. A consistency, they might have a very much bigger win rate, they might have a better risk reward, and everything comes to an endpoint of risk management. You could be the best trader, but if you're not managing your risk well, you would end up 1 or 2 days you are consistent for the past a month or two, and one day you would just blow up, and just give back your months of profits. And has happened to so many people I work with, has happened to me, where I haven't been have been consistently making money, and one day I just completely give back weeks and months of profit. And the way you want to systemize that as a discretionary trader, or as a discretionary retail trader, is by setting some technical rules around it. Because a lot of times when you introspect on what kind of a trader you are, whether you are a new trader or a professional trader, everybody goes through some or the other ways of psychological issues that comes through. It could be revenge trading, it could be FOMO, it could be over trading. But one thing that I explicitly, when I mentor traders, when I talk to traders, when you're new specifically, you absolutely want to have a technical rule of managing your emotional problems. And when I say that, a lot of people say that I'm struggling with the psychology, and I'm struggling with the FOMO, I'm struggling with revenge trading, I'm struggling with impulse trading. But the the root cause of those emotional issues can be handled in a technical manner. For example, let us say that you're struggling with overtrading. You're struggling with not taking those playbook trades that you should be taking. What is the technical way of, and you could say, maybe I should take less trades, or maybe I should uh, manage my positions well to be able to take less trades, or maybe should work on the psychology, and maybe I should not be frustrated. And those are all good stuff, but they are not actionable stuff. And what is the actionable stuff? The actionable stuff should be, okay, maybe I'm a momentum trader. At an average, a good trading for me, 8 to 10 trades on a daily. If I'm taking more than 10 trades, my risk or my performance hasn't been great. So go to your software, go to your broker, and ask them to stop your trading by if you hit 10 trades per day, or maybe 8 trades per day. And that's a technical way of stopping yourself, that you whatever trades you would be taking in your head or a subconscious mind, you would be questioning yourself that, is this trade worth taking it, because I only have limited numbers to work upon. Same thing with revenge trading, finding a technical way to handle it, and also not that blowing up your account. Having It's very simple way of managing it, or having a technical way of handling it, is that having a max loss set up. You are logged out of the system when you hit your max loss. There is no question asked. Come back tomorrow, and then come back again, and you should be able to trade another day and not blow up your account. And that's the whole thing. If you are able to manage, if you cannot manage your emotions enough to be able to take decisions by yourself, have a hard stop for yourself to do it for you. And you would be thankful for those hard stops, because in the prop firms, that's exactly what's happening. There is a risk manager sitting behind you, watching you trade. And if you are not in the right frame of mind, the manager is going to ask you and ask you to step away and not be done for the day, and you're locked out of it. And as a retail trader, you can do the exact same thing for yourself. And that's the first suggestion that I would give, that if you want to be consistent, have a technical rule behind all the psychological issues you're facing. And once you have that, eventually you'll start seeing those small ads would actually start making an exponential difference. Take less number of trades. Process your playbook. I think a lot of the root cause for me specifically, when I was going through this, where I was like taking those random trades which I should not be taking, or maybe you make up those trades saying that, oh, this looks perfectly as in setup, but looking back, it wasn't your setup. So you have to refine, create a structure of what kind of a trader you want to be. You want to be a momentum trader, you want to be a trend trader, you want to be a counter trend trader. You want to define your or create your identity for yourself on what kind of a trader matches your nature, and then refine your playbook to an extent that, and categorize them into your A plus A, B plus B setups. And if you don't see those, the more you refine it, the less you will trade it. And the less you would trade it, you'll not be taking small cuts. And one thing that I would highly recommend is trade less, but trade big. So take less number of trades, but the trades you take, be confident enough to be able to scale into the position on those setups. One of the things I would definitely mention, two things actually. One thing, have a realistic expectation in the world of trading. For all the retail traders out there, there's um, so much out there in the social media claiming that, oh, 1 month or 2 weeks. Consider trade it as a career, not as a gambling mindset, but as a normal engineering, or when you go to a med school or when you go to an engineering school, it takes around 3 to 4 years of your time to be able to start reaping those benefits of the work that you're doing. Have some realistic expectation on what on when you will start making money, because trade it as a career and not as a gambler. There's a very thin gray line between a gambling mindset versus a trading mindset. And secondly, I would highly recommend understand what kind of a person, explore all the areas, explore all the futures, options, equities, all the different ways, swing trading, day trading, when you're starting as a new in your career. But refine yourself and see what your, as a human, as what nature suits you best. For example, I am a very, very impatient trader, but I'm good with reflexes. I'm good with, I can take decisions quickly, but I struggle with being patient. I cannot hold on to a position for a big move and just sit back and just rely on the stock to move in my favor. So for me, uh, momentum trading and scaling into the position, managing those positions, actively make much more sense for me, because I can, take some quick decisions to get out and get back in, and then scale into the position and keep those P&L register ringing over and over. Again, every single person is different. You want to understand who are you and what makes more sense to you. There are n number of ways of making money in the market. You want to find one that matches your strengths and matches your personality. If it matches your personality, then you will the probability of you winning in the career of trading is very, very high. I come from a very a professional. I played professionally a sports called badminton, and that also required a lot of quick reflexes, which is why I think my nature has turned out in that way, where my strengths are based on quick movements, based on the momentum, and then scaling in and scaling out of the positions actively as an active day trading standpoint. So those are those two things that I would highly recommend, that have some realistic expectations, and understand your personality and trade your strengths.